Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in. Take a look, see what's getting shared. If you want to follow me, it's at Find Your Square Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities, sharing them with the community, and then sharing my experiences, sharing some of the things that I've learned through my investing, I'll say, process. And you guys can see kind of how I select companies, why I select them, where I purchase them. I share all that stuff on the website. There are some training sessions on there too, technical analysis, and some cycle stuff. We do have a coupon code special, is the coupon code if you'd like to join. It will work with both the monthly and yearly membership. Scroll down to the transcript. This is Buffett. We'll start off with one of his quotes. He says, "Life today is better in almost every way." You've got to figure out that you started at a pretty lucky spot just to be born when you were. Imagine staying in some cosmic waiting room for hundreds of thousands of years and then getting dropped into the present. Not bad timing. So I would focus on what's been good in your life rather than what's gone wrong. Yes, bad things can happen, sometimes very bad things, but life can still be wonderful. So that's just starting kind of with a gratification, not really gratification, I should say someone who's content with being where they're at. You have to keep in mind that we are, most people, if you're in the United States, you are incredibly wealthy. Even if you are, quote, middle class, the middle class today is much better off than hundreds of years ago. So just, don't take that for granted. You're in a pretty good spot, and you've got a lot of opportunities that a lot of other people did not have. Jordan says silver's performance after gold's initial post breakout peak. Gold's had 6 breakouts. We plot the 4 best comparisons. The average excludes the 1978 to 1980 moonshot. The average nearly reaches $50 12 months from today. So these are multiple areas over here. We've got 72, 78, 2003, 2009, and then 2025 is just starting. It's all the way on the left over here. You can barely see it. So it's right like there, like right on the left side. So if you were to take the average of these moves, the average is right around 50-ish, 50 something ish dollars. You can see the average excluding 1978. Other ones, they've gone up past 75, $80 an ounce for the silver price. And it's done that 12 months from today, is what Jordan is saying. So we could see a pretty big move in silver here, probably, yeah, within 12 months or so. And, I'm going to pull up a silver chart here. This is the silver chart that I've got pulled up on the long term. One thing I want to state is these moves last for a long time. So when we go through these big consolidations, they tend to move. And I think people think that it's just going to go like rocketing higher. I think that we are located like right here. So that's kind of where I think the X is, right there. Maybe even a little bit before that. Um, you could even say that we're like right here. So we've got this double bottom there. There's the double bottom. It's got the same fractal. And I think a big driver of that is going to be an increase of interest rates. This was an increasing interest rate environment all through here. We just went into that, I'd say, over here. So one could even state that this X there is like somewhere in this bottom here, and that we have a long way to go of a potential move higher, depending on what interest rates do. When interest rates fell, we created the cup and handle. So that's that cup and handle there from here to here. That's a decline of interest rates, and that was the consolidation. This was also a decline of interest rates. This was an increasing interest rate environment, and this is an increasing interest rate environment that we just entered. So this isn't a short-term little movement. It's not a trade. I've been in this since right here. That's where I purchased a whole bunch of my stack. It was all right there, and I bought the living crap out of it. And I've been in it for a while, and I'm going to ride this thing probably for the rest of my life, perhaps, maybe, or I'll swap it into other metals if silver gets really expensive against other ones. But I don't have the short-term view. I just sit in this stuff and I ride it. I ride it. There's a lot of really long-term themes that I think will work really well over my entire life. I think that we are going to adopt nuclear energy for the rest of my life. And there's going to be just crazy nuclear in the future. I mean, just crazy amounts of investment going towards it. I think anything that is a metal, gold, silver, platinum, palladium, copper, I think they're all going to go up astronomically higher. I think we're going to develop graphene or something similar to graphene. I think we have to. And I think energy will be probably one of the best areas to be looking at for a long-term investment because everything that humans want to do, everything that we develop, everything that we design, and all wealth is tied to increasing energy, all of it. And you don't have to get too fancy with anything. You just pick a couple of things we know that works and stay long in it. If silver is a key component to the electrification of the world, like that just seems like an obvious no-brainer to me. If copper is one of the other key components to an electrification of the world, that just seems obvious. Like it just seems obvious. Now, it doesn't mean just because it's obvious from the physical metal standpoint that the companies are going to be good, that all the companies will be good, but you have to be picky, you have to be selective, and I don't think everything will work out. And copper, there's a lot of really old mines right now, and I don't know too many new mines that are big coming online that can really plug the holes of supply for demand. So the supply side, I think, is it looks pretty bad. like I can't when I look at some of these areas for investment over these next few years, I struggle to see how the supply gaps are going to get filled. Like I just look at it like, where's this all going to come from? I don't have an answer. And that's what makes me so bullish on half this stuff. And yes, it's going to be in the late 2020s when it all hits for a lot of these things. Nugget Capital Partner says, all I know is that if oil goes into the 40s, it is going to be a table pounding buy opportunity. If it goes into the 30s, oil stocks likely offer life-changing money opportunities, assuming you weren't all in ahead of time. Bring it on HRH, final flush of the oil bulls. And this is OPEC not even halfway through the voluntary cuts. And once they get through the voluntary, then they have the actual base quotas to unwind. I think we have 1.5 to 2 million barrels per day of spare capacity that is steady. I don't think there's anything really more than that. We have some maybe swing capacity that Saudi has, maybe 1 million or 2 million barrels per day, but we've never seen them go to a 12 million barrel per day holding steady production. We don't even see them go to 11. So I don't know if that actually exists. Now here's another thing. If we have so much oil, why isn't any of it showing up in inventories anywhere? We are hundreds of millions of barrels below average across the SPR and our commercial inventories around the world. If we're choking on oil, where is it? It's not an inventory. So, what are these people basing these prices on? Is it the lack of demand in the future that hasn't showed up yet? Is it a potential recession? Now, if you go back in history and you look at the recessions, 1990 recession, oil demand didn't go down. It went up, but the growth rate went down. So we didn't grow oil demand as fast. That also happened in the year 2000, 2001. We didn't get a huge hit worldwide where oil demand went down. It still went up, but the growth rate slowed down. The only spot that went down was the great financial crisis, which was a deleveraging, deflationary event. And demand worldwide got hit by 1 million barrels per day. If all we have is 1.5 million to 2 million barrels of spare capacity, and all the other guys have been cheating, which I think they have. So the only person out there is Saudi with spare capacity for the most part. Where's all this oil going to come from in the future? And if we really start to roll over in the Permian, which means that America's production of non conventional oil starts to plateau and potentially roll over, whatever that rollover looks like, that's not going to be a viable area for growth. And if it rolls over, we're going to have to replace those barrels of whatever it's losing. I have no idea where it's going to come from out in the future. So when I look 3 years out, just 3 years, so we'll eat through the voluntary cuts here in the spare capacity in OPEC. Probably it'll take about a year. We eat through that in 2025, maybe 2026. It still has a little bit left. So we eat through that, and then what's next? How are we going to build back the hundreds of millions of barrels that are missing in our strategic petroleum reserve, and even the commercial inventory levels are low too? Across the board, not just America, it's low everywhere, China, whatnot. How are we going to build that all back up? Are we going to build it back up? We're not going to build it at $30 or $40 a barrel. I'll tell you that. Coming on down, investment wisdom. It says an ability to detach yourself from the crowd. I don't know to what extent that's innate or to what extent it's learned, but that's a quality you need to separate yourself from the crowd. Kevin Bambro says, what most new mining cycle investors quickly discover is that commodity prices going up 2x barely help many of would-be producers. The trouble is when commodities go up in price, so do the cost of producing commodities. Sometimes the equities run ahead, then lag as the commodity price needs to catch up. Other times the commodity price leads. Once bitten, twice shy. It's a rope-a-dope for many. Commodity bulls are tricky to ride. The biggest success I've had came as a result of rotating from sector to sector, playing whack-a-mole with my portfolio. I try to find good stocks to play in major commodity sectors, then take profits after great runs and buy the lagging sectors. Agriculture, potash, phosphate, oil, gas, coal, uranium, platinum, silver, gold, copper, moly, nickel, etc., etc., etc. So he kind of just rotates of what's up to what's down. Kind of a ratio play, to be honest. Um, I think what's coming is going to be a large inflationary uh, environment, and I think they're going to go up. Remember that chart I showed earlier on silver? I think that we're going to get a big bull market, something on the lines of that. And I'm not going to be selling in and out, even though you've got some pretty good years going across or sideways. I'm just going to ride the whole damn thing. So rather than me trying to do whack-a-mole, what I do is I spread my portfolio out across what I think are the best commodities, and then ride it for the entire bull market. Now, some people say, well, some of them have big pullbacks. That's true. They do. You can see pullbacks of 40 to 60 to 70%, depending on the company that you had purchased. The smaller ones go up a lot, and then they pull back a ton. So what I do is I just let it go. I don't worry about that. And usually something offsets because they don't all go up at once. It depends if you get slowdowns in the economy, if the economy speeds up. If the economy speeds up, that's when your inflation sensitive ones go up, like fertilizers and energy. If it slows down a little bit, that's when your gold and silver and some of your precious metals do very well. So you can set up a portfolio where certain things work under certain market conditions, and it kind of like balances it all out. It doesn't mean you go nowhere. It means that you still go up because the asymmetry of each sector is so big, which means you can get 5, 6, 700% upside when something goes up. And then other ones, they could lag or go down 30, 40, 50%. So if you've got an allocation to a sector with that much asymmetry, it pulls the whole portfolio up continually. That's your diversification across sectors that are not correlated. They're uncorrelated assets. Energy Cynic says it's good to remember that whatever WTI print you see, you should cut by 25% to adjust for COVID inflation. 27% since 2019 to show on a real basis. So the old today, the new 60 is the old 45. The new 50 is the old 37.50. The old 40 is 30. Dumb as rocks to drill into any of this. So obviously the companies don't want to drill into that because it's too low. And then your supply gets pulled back. And I think we're going to see supply pull back in shale in America. I could see maybe supply pull back in some other areas too. Maybe offshore doesn't grow as much or maybe even go down. The biggest thing about money or making money is time. You don't have to be particularly smart. You just have to be patient. And a lot of people are super impatient. And I would say the majority of people in this world, they're probably closer to gamblers than they are to investors. Investors, here's the difficult part that I don't think a lot of people understand. When a view or a glimpse into the business occurs once every quarter, that's it. Once every quarter. And once every quarter, so that's once every 3 months, they release their earnings and you get a glimpse into perhaps what their business is doing, the health of it, if it's growing and whatnot. There could be a bad quarter or two. Well, that's 6 months, 2 quarters. And then you have to wait for it to come back into favorability or into a market condition that works well for them. And for most people, that's far too long to wait. They want instant gratification. They want things to move immediately. But that's not how investing works. If you notice, all of the best will tell you you just have to be patient. What does patience mean? It means that you're going to have to start looking at things from a decade perspective. And hardly anyone wants to do that. They want to get rich quick. They want to get rich now. I don't want to waste my time holding on to something for 2, 3, 4, 5, 6, 7, 8, 9, 10 years. The problem is, what strategy are you going to deploy where you can successfully navigate your expectations? I'll just say this, those people go broke. Gamblers go broke because they'll adopt strategies with super high risk, like 0 days of options, like 0 days to end of options, zero DTE. And most of your moves there are just it's gonna be broke. And maybe by sheer luck you can hit something big. Maybe. I don't know. But that's not how the greats have made their money. Their greats made their money by watching paint dry and putting money when things were cheap and just literally not ever selling them. They just collected a portfolio of companies that they never sold. And that's how they made all their money. They bought companies that wouldn't go out of style or wouldn't go out of favor. So food, beverage, insurance companies, banks, like stuff like that. Just the good old boring stuff. Maybe large integrated oil companies, whatever it is. That's kind of what they invested in. Pretty boring. Doesn't sound like it's all that great. But here's the thing: If you start young and you don't think about it, you just go in and let it ride, and then eventually you look back, 10 years just flies by the older you get. You'll look back and say, man, I was pretty smart for putting it in there and not selling it. And that's kind of how it works. It's what will happen with most people if they do learn is that they'll try to take on all the risk in the world. They'll lose their ASS and then they switch to a different strategy that works. And by the time you figure that out and switch to the strategy, 20 years has gone by. And if you just started with that strategy in the beginning, you'd be far wealthier with the 20 years of compounding that you had versus trying to get the get rich quick scheme. You wasted all that time. Here's another one from Peter Lynch. Confusing the price with the story is the biggest mistake an investor can make. Confusing the price movements up and down is not the story that's behind the investment. What I see a lot of the times is that investors get scared of market movements, fast market movements, even though the story, the thesis, the company, nothing's changed. Guys, it's so hard to change a thesis. It's so hard to change the story of a company. I mean, yeah, something can happen where they go bankrupt, like some poor design of a product caused a massive, deaths or something, then yes, that can happen. But if you're in these boring companies where you're in insurance or whatever, you just sit. And if the market goes down, what people do is they get emotional and say, "I'm going to sell it," but it doesn't change anything with the company. All it is the overall market swinging up and down, just like oil up here, right? Just like oil, this is just oil swinging up and down because of what people think the market's going to do. Oil, you can't make oil at $50 a barrel go up. Like we will not be increasing production at $50 a barrel. It is a dang near impossibility. Even at 60, it's not going to grow. You're not going to grow oil production. So the next question is, okay, well, if I buy it down here, how long will it take to make money? It's like it'll take some time, but you're underneath the cost curve. Like it will happen. It will go up. And if you're in a company that's not going to go bankrupt and they don't have a ton of debt, you're fine. Just ride it through, ride it on, buy more and ride it on. But a lot of people say, well, it's a lost opportunity. I should have been into something else. So now you're trying to buy and sell. You're trying to flip flop back and forth. Um, it gets real difficult, guys, because what you're then having to do is read the market better than everyone else. You're saying that you can time it in the short term better than other people, and I don't know if that's possible. I think there is a function of randomness in it, and there could also be a function of some part of um, controlledness, maybe in some areas for a brief period of time. And I just think it's real difficult to do that. Michael Oliver's emphasizing that silver is poised for a major breakout after a year of sideways price action and a recent sharp correction. So he's trying to predict price movement. Um, what I do is I look at things maybe a little bit different. He's using momentum, and I kind of understand what he's doing, and he's probably pretty good at it. But I just look at the big long-term, big picture view charts, like the silver one, and then I see what's correlated with it. And if what's correlated with it's going up, then most likely silver is going to go up. So if gold's going up, and you've got interest rates going up, then silver's most likely going to go up. And then you just ride the whole dang thing. You get a good entry point real early, like in that circle there, and then you just ride it on up. It's that simple. And everyone, what they're trying to do is they're trying to make money on these every single little market movement up and down in the short term. That is incredibly hard to do. I don't know of anyone who's really good at it. I don't know of any billionaire that's made billions of dollars. Even the ones that do make billions, the way that they did it is more so in the strategy of capital deployment and asymmetry than it actually is in them making successful calls. So I think there's a big misconception of how people who are really good, how they actually made their money. Like George Soros made a bunch of money, but he was actually incredibly unsuccessful in terms of his probability of success. His probabilities were incredibly low, but what he did is he had these huge asymmetric wins with small downside losses, and then he won a couple of these where the asymmetry carried his entire portfolio massively higher, and he made these bets where he wouldn't lose a lot if he made the bet, but if the bet turned out right, he would make a whole bunch of money. So he took a whole bunch of those bets and he would lose on a lot of them, but he didn't lose a lot of money taking them. And then he made a whole bunch on a few of them. And that's what really generated a lot of his wealth was making astronomical amounts of money in a bet, but losing very little on a lot of bets. And one of them, a couple of them paid off over his life. Here's this is silver, and he says the 3 quarterly time frame on silver is still strong as ever. It looks fantastic. Agreed. This is platinum, one of the hottest coil springs right now is platinum. Currently, there's nothing to do but wait for it to break the blue wedge and clear 1050. After that, I believe it will be one of the strongest commodities for a few years, but now you just wait. I was buying all at these bottoms here, right at these bottoms underneath a certain spot, and I just keep loading up into it. A lot of people say, "Oh, well, your platinum, the platinum call hasn't worked out yet." It's like, well, just be patient; it'll come. It'll break out. It'll make a many multiple move, and there's benefits of being out of the system with it. And we'll get a big breakout, and it'll run for a long time. I made a ton of money on palladium. I purchased it in 2005. It didn't. We can pull up the palladium chart real quick. I purchased it in 2005, and now back then I didn't know the ratios as well as I do today. I just knew it was cheap. Uh, Call it a gut feel, so to speak. But 2005, I bought some in here back in the day on this big, pullback here. We've got almost the same setup if you guys look that we have today. So here, I'll show you the setup real quick. So this setup, this big pullback that we got here, um, you can see that it's basically the same setup. So something like this could occur, and that's probably what will happen is something like that will occur again. And that fractal, I didn't even change it. It's basically the same fractal that's playing out. Fractal's a repeating pattern over time. So I bought it in 2005 here. I bought a bunch in that circle. It went up. It came back down. I bought more in the circle again down there. I call that kind of like a retest or another move lower. 2008. I did it in 2009. It was around 200-ish dollars. I wrote it all the way up here, the entire way. I actually swapped it here, and I went into a different metal. That's what I wrote. Now, people here are going to say that I was wrong all this time. Wrong, 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 wrong. And I bought it again, and I wrote it all the way up here. So that move was 2000. So it was about 10 times my money. So did I miss the opportunity making 10 times my paper dollar value going up here? Uh, no, I think that was a great investment. And I held it the entire time. Now, did I know what exactly I was doing? Because I was a new investor here, and I just saw it was cheap. I didn't load in like I could have, knowing the things that I know today. So platinum's my big bet. So what I did is I took my palladium and swapped it over to platinum. So here is the palladium platinum ratio. I didn't know about the ratio back here. I just knew it was cheap. I didn't follow ratios in 2004 and 5. I started learning about them over here. And when it retested in 2009 and started coming back up, I figured, you know what, this is starting to go back up. I should buy some more. I wrote it all the way down here and swapped it right there at April of 2020. I actually got lucky and basically caught the bottom. I was looking at swapping it before that, where I was going to swap it kind of like over here. And I was like, you know what, this is really low. And then I just was lazy. I didn't want to go. I made a call to my local coin shop to see what pricing I could get. And then in April, it was after March crash. I was like, oh my God, I'm going to have to go in there. The ratio is literally, I almost got 3 ounces. It was real close to my swap. And yes, there is some premiums that you have to pay for and when you do the swap and stuff. So it was 2 point something that I received. And now we're at a one-to-one relationship. So I'm already up almost 3 times my metal, so to speak. So it's good that I swapped it. But I hope that this can go all the way up, back up here again. You can see the cycle, maybe 2030, late 2020s. So I'll just hold on to that metal for another 5 years or something like that. And if we do get to this level up around here, I'll just call it 5 to make the math easy. That means that the metal I swapped here at zero point 0.3, if we go to 5, that means that I will get 15 times my metal, irrespective of the price, if this ratio goes up there. 15 times. And I wrote it from here to here. It was one cycle worth. That cycle was 2009 at the total bottom to maybe it's about a 20 years, 10 down, 10 up. That's also a significant value because the real estate cycle is 18.5 years. And I think this is a function of the real estate cycle somewhat driving this. So hopefully that plays out. And if I get 15 times my metal, I mean, that's incredible. Absolutely incredible. And I'm playing these ratios with kind of everything. And you can even look at like a palladium to silver ratio too, which you can see buying. So I bought palladium down here at the bottom. Against silver, silver outperformed for a little bit of it, but it went all the way back up here. And this was also a time I was looking for a potential swap of palladium to silver, but the silver premiums jumped dramatically here. So what I did is I swapped it into platinum. Now, this would have been a heck of a swap here because it's already coming down. We're at a very low level. I think we're going to probably bottom somewhere over here before it starts to come on up, though. So it's going to do a similar move to here, and we'll get a very good opportunity to buy palladium out in the future, is my opinion. So that's some of the things that I do, and you know what this all requires? Requires patience. It requires buying a whole bunch of metal at really good locations and then sitting and doing nothing. You can play multiple metals at one time. You don't have to go all in on one, and you can shift your ratio allocation or your allocation based off the ratios is what I should have said. So yes, silver would have been a good one here, and that's exactly what I did. I bought silver here too, and I got platinum. You can look at the platinum to silver ratio, where it's very very cheap. Platinum's cheap against silver. I own both of those metals. I'm not all in on one thing or the other, but if this breaks and comes up here, oh my God, it's going to be insane. Now I can't swap back into silver; it would be too many ounces. I'd have to have an armored truck to move it. Just at, at that point, it'd be so many ounces, it would be ridiculous. But yeah, we'll see what happens out in the future here for that. Josh Young says OPEC Plus announces another 411,000 barrels per day oil production adjustment in June. You know, read this production adjustment. What does that mean? Production adjustment. Does that mean they're going to raise production? Or does that mean that they're going to do a 400,000 paper barrel production adjustment? Is this even legit news? It says in view of the current healthy market fundamentals as reflected in the low oil inventories. Yeah, we need to bring barrels back, guys. We just went through a bunch of weeks where we had many millions of barrel draw in gasoline and oil and distillates. If they increase production by 411,000, it doesn't increase the offset that we're seeing in build season. Like, this is so incredibly bullish that it seems to fly by everyone, at least in my view. David says the K wave commodity cycle, human beings conducting their affairs according to specific patterns. Commodities are the fuel of modern empires, and resources are the main reason why humans fight each other. Maybe we got war coming up over some resources. Buffett says there could be things that would happen in the US that would make us want to own a lot of other currencies. It's a weaker dollar, guys. The weaker dollar's coming, and that's my whole thesis on commodities going up and emerging markets. It's all based off a weaker dollar. Here's Buffett coming out. That dollar looks kind of, it makes you want to own a lot of other currencies. That's exactly what I'm seeing. John Templeton says, to buy when others are despondently selling and sell when others are greedily buying requires the greatest fortitude and pays the greatest reward. That's what you need to learn as an investor. And that's Brazilian stocks. I talked about that last time. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got a question and answer session coming up 5 p.m. Mountain Time today. So if you want to join the website. Use that special coupon code. Log in. Find the Zoom meeting, and you can go into the Zoom meeting and ask me whatever you want. There are other people on there too. We get a good chunk of people that show up, and you can ask whatever you want. I will be covering a couple of things that people have already asked me about, kind of along the lines of how I determine my purchasing decisions, and I'll go into it. A lot of it deals with the combination of many things. It's not just one thing. What I see a lot of people do that I think that I would disagree with is they look at one chart, they look at a couple of patterns, and then they go and buy it. That's not what I do. That's not what I do. It's more about piecing together a puzzle. If that makes sense, and we'll dive into it during the meeting. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.